So initial jobless claims came in below the survey number. So far today, the markets are doing pretty well, and it's adhering to what we talked about before. When the VIX goes over 30, that's often a good contrary indicator. I have a caveat I want to talk about today on open interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Market. So we're actually live streaming today while the market is still open. Usually it's after the close. We thought maybe it's a little bit helpful to take a look at what's actually going on intraday. Obviously, one of the things that happened at 8:30 this morning, we got those initial jobless claims. They came in a little below survey. The survey number was for 240,000. We got 233. So the angst that prompted the big sell-off on Monday, which was the unemployment data from last week, was mitigated somewhat. Now, just a quick reminder for anybody who didn't see what I've previously discussed. Generally speaking, as the market declines, volatility increases. We see that in terms of implied volatility when we can watch something simple like the VIX index. And I have pointed out that I often like to look at that sometimes as a contrary indicator. So when the VIX gets above 30, generally speaking, the S&P's returns over the course of the next month are better than they are in the general case, at least going back to January of 1990, which is far back as we actually have VIX index data. Just a quick refresher on what those numbers are. Generally speaking, since 1990, the 30-day, 1 month-ish returns for the S&P, a little over 80 basis points, probably about 84 basis points, and the probability of profit, that is the likelihood that the market is higher, or more accurately, we could say the number of instances where the market was higher a month after on any given trading day was about 64%. When the VIX goes over 30, those numbers change quite markedly, and you actually get an average 1 month return of almost 240 basis points or thereabouts. So you're looking at numbers that are nearly 3 times better than what you normally see, and more importantly, the market was higher about 77% of those occasions. Now, those occasions are relatively rare. How rare? Well, we're talking about maybe 340-ish trading days when the VIX was north of 30, going back to January of 1990, so it's not a very common occurrence. And if you have been watching this market and you are wondering, how come I feel less comfortable piling in and getting long here when the VIX did this than I normally do? And I was kind of wondering that myself, and the conclusion I drew is that it's not that common for the VIX to go north of 30, and in fact intraday on Monday it went much higher than that without a meaningful pullback. And what's a meaningful pullback? I'm talking about formally a correction, which is a 10% drawdown from the prior all-time high, or even a bear market, which is a 20% pullback from the prior all-time highs. We didn't get anywhere close to a bear market. We got relatively close to a formal correction. So what I did was last night I was just taking a look at this. It turns out that actually there's only one instance since 1990, excluding the environment that we're in right now, where the VIX actually breached 30 to the upside, and we did not experience within 1 month prior or 1 month following. And I mentioned 1 month following because, of course, we don't know what's going to happen over the course of the next month, but we're trying to take an educated guess here. There was only one instance when the VIX breached 30 to the upside, and we did not have, at the very least, a market correction within either 1 month prior or 1 month following. And that period was late October, early November of 2020, which is the last time we had a presidential election going on. We were also coming out of the pandemic plunge. So that was kind of an extraordinary period. What's interesting, of course, about that is that we are going into another presidential election, and one of the candidates is the same. And I think it's worth asking ourselves whether it's possible that some of what we saw on Monday hints at the fragility that's in the market. The yen carry trade is one part of the fragility. Another part of the fragility is simply, I would argue, based on some of the short vol products. There's a lot of those. And also there's a big short vol trade or short correlation trade. The dispersion trade, where market makers are traditionally long volatility in single stocks, short index, and we've seen very low correlations. Those have ticked up. Implied correlation has ticked up significantly. But if that trade remains crowded, whenever you have a traded crowd, that creates some fragility. Okay, so let's just go very quickly over some of the things that we saw today, some are seeing, I should say. So I just wanted to talk really quickly first about some of the names that are seeing above average volume. Top of the list on the call side is Dutch Brothers. Dutch Brothers is, the drive-in coffee, fast-growing drive-in coffee shop. They reported earnings. The stock's down about 21% as I speak to you now, and it has traded about 20 times its average daily call volume. So the numbers themselves actually weren't all that bad. Where it disappointed folks is that they are rapidly growing and they're opening a lot of new stores, and that is where they are disappointing investors. The other thing I would say is that they gave some guidance to two sell-side firms quickly came out, reiterated their buy ratings. Those were TD and Jefferies. They're hinting that they think that it's fairly conservative guidance. They think they're going to beat it. So I just wanted to talk quickly about the flow that we're seeing there. So I generally do not care that much. When you have something like earnings coming out and you get a huge amount of options flow, I'm usually not that interested in the really near-dated stuff, the stuff that expires this week or next. Sometimes you're going to see that. That's just people either trading into or out of a position. That's fine. I like to look a little further out, and if we do look further out, so if I just look out to beyond the end of this month for what's going on in terms of volumes, obviously the volume is going to be a little bit reduced. It was about 22,000 contracts, I think, as I speak to you right now. But the most active contracts are the September 30 calls. About 3,500 of those have traded so far. The stock's trading about 29.7. It is short sale restricted. We had Jim Seligman on the live stream last week. Probably would be pretty interesting to have him in here now to see whether he's seeing any action in that one. Beyond that, some of the active flow is in the October 45 calls. I wouldn't make too much of that. There's about 2,100 contracts traded, but that's against 4,300 contracts of open interest, and implied vol is down. There's just not much to that contract. I don't think people are forecasting it's going to get back to those levels. Same thing with the October 40s. The October 30s, on the other hand, have traded almost 500 contracts. That doesn't seem like a whole heck of a lot, but if you take a look at the average 20-day average volume, 500 contracts, 50,000 shares worth, that would probably represent 12 to 15% of the average daily options volume and about 20% of the average daily call volume in any normal circumstance. And my guess is that you have some folks rolling down, and the change in implied volatility on that being greater than what we've seen in some other places could be that some folks are actually overwriting some long call positions. They're getting about $3 for those contracts. So that's, if you're long the stock and you're saying, okay, well, maybe I have an opportunity to claw back about 10% of my losses here. Not that 10% is all that phenomenal. Stock's down $8. You're going to get about 3 of it back if you're overwriting and you don't think that they're going to do much. Does that matter in terms of expirations? It does actually in the following sense, which is the next big catalyst, which is likely to move the stock here, is going to be the earnings that they're going to be reporting, which, as I just said, sell side is a little bit conservative on, or believes the company's being conservative on. That is scheduled to take place in the first week of November. Okay, so unusual volume, what's next? So in Dutch Brothers' case, that was just in response to earnings. The next biggest unusual volume, trading about 7.5 times its average, is Expedia. Expedia, by contrast, this is not in response to earnings, but prior to. So the stock's up about $4, and we have earnings post-close today. And right now, the options market's implying a move of, give or take about 10%. So in terms of so here actually I think it is a little bit more interesting what's going on short dated. This is because the catalyst is still ahead of us. So we know that they're going to be reporting after the close today, and we have options that are expiring on this Friday. This one has dailies. So we're really taking, when you see the flow today, we're really just taking a look at people targeting that catalyst specifically. All of the most active contracts expire this week or next. The most active contracts right now are the 119 calls, which now are only about $2 out of the money. And those are buyers, about 2,700 contracts, 127 calls. Also trading over 2,000 contracts there. Those things are trading for about $2.25. So in fact, if you take a look at the options flow today, what you're going to see is that of the top 10 most active contracts, all are calls, except for the August 16th regular way 100 strike puts. And what's interesting about those is that where everything else is seeing implied vol increases of 20, 30, 50%, the August 16th regular way 100 puts, it's not really getting bid up that much. So the flow in Expedia is consistent with the intraday price action. It's pretty bullish. Okay, so just rounding out the top three in terms of unusual options volume. So third on the list is Kellanova. That's ticker symbol K as in kilo. This one trades less than 2,000 call contracts a day. On average, it has traded about 13,600 contracts so far today as I speak to you. And so what is going on here? Mars, M&M Mars, I guess, is thinking about buying Kellanova, their snack maker. And the question, why would people be buying calls here? So, usually what you get in takeover situations, people speculating on a deal, you see a lot of buy right activity from the risk arb players. So they buy the stock, they sell calls at strikes where they think the deal is going to take place. That's kind of a common thing to do. We can see whether that's what's going on here by taking a look at the implied volatility. Indeed, the August 75 calls, implied volatility is down about 8.7. So that is what is going on there. For those who are inclined to play in a risk arb space, which is speculating on a potential deal, the question that people would normally have is, will this get by FTC? So are they going to have any antitrust issues? I'm going to guess that there's a decent chance if you're watching this, you'd never heard of Kellanova before. You may, and the reason I bring that up is I don't think it's probably, and most people are reporting, they don't think that there's going to be a big antitrust concern here. And it's up only marginally at this point as we look at it. So a huge amount of juice in it, probably not. This was the news that had come out last week. But most people are just basically saying they think that they don't have to worry about the antitrust issue, which is interesting because Lena Khan has, they have been a little bit more aggressive on some of the other antitrust stuff. Okay, so that sort of rounds out the top three on the call side. So on the put side, number one is Akamai. Akamai hasn't actually, this one seemed to have quite a lot of flow years ago, not so much anymore. This doesn't trade huge volumes on average, although it has a decent amount of put open interest. And we're looking at 80,000 on average, 80,000 open in terms of the put side, so 8 million shares worth, roundabout, a little higher now. It has traded 10,000 puts today, actually a bit more. So just a quick review of what's going on there. All right, so, and I'll tell you which contracts are really busy. So this one also is going to be reporting after the close. substantial earnings-related implied move, about 12.5%. Stock, we're on an up day. A couple of stocks, including Expedia, as I mentioned, going into earnings, trading quite well and up decently. Not so here. The stock's mildly lower, about 50, 60 basis points. The most active contract are the August 16th regular way, so expiring a week from tomorrow, the 80 strike puts. We've seen about 1,900 of those trading. Those are trading for about $2.50. $2.50 on an 80 put. So let's just take it, round numbers, 77.5, 77.5. That's $15 lower than the stock is currently trading for a break even. It's about 20 delta option, but obviously that is expressing a little bit of skepticism going into the number. Also active are next week's 87 strike puts and the September 65s. Again, so they are reporting after the close. Actually, why don't you just pull up maybe we'll just pull up a chart real quick on Akamai, because this thing has really not been trading well at all. As this chart will illustrate if we pull this one up on the screen. Let's see here. So I'm just going to make a 1 year. I think that's probably, yeah, we can see this is not great. So at this point, very quickly, what I'm going to do is just take a look at, see whether there's any technical indicators here or any reasonably successful technical indicators that indicate one should be long. And what do we got here? So yeah, it looks like most of the technical indicators, well, we've got a couple that are bullish, but there are more bearish indicators than bullish going into the print. And that's, I mean, I didn't see an obvious level of support there. I'm sure you didn't either. Okay, just moving on, and we don't need to, let's see here. Okay, so that covers Akamai. And all right, so next up on the unusual put volume is Wolf, ticker WOLF, Whiskey Oscar Lima Foxtrot. I'm just going to spell that out so you guys can follow along if you want to. 24,020. Go ahead, Brad. Sorry, I didn't catch that. Oh, yeah, that's right. Yeah, so I'm just giving the NATO alphabet from time to time on these tickers, because if I'm blowing through something quickly, I want to make sure that everybody knows what I'm talking about, especially if it's, I know I don't need to do that if I'm talking about spiders or CrowdStrike or NVIDIA or Tesla. You guys all know the tickers for those, but in some instances you may not. So in this case, we're talking about Wolfspeed, semi name. This one is also short sale restricted, and some of these charts, I actually, if I'm gonna pull up a chart here to show you what I'm talking about. I actually have to go back more than a year because it's just one big downtrend. Short sale restricted probably would be good to. How far back do I have to go to actually see anything but this downtrend? My God. Yeah, so not a pretty picture in this one. Just quickly, we'll just go over what the most active contracts are. It's the SEP 10 puts. Implied vol suggesting that these things were bought. 5,000 of those against 520 open interest. That is quite a bit lower than where we are now. I mean, this is just trading like it's a broken stock. Even though it does have, did get a pop today. So they are going to be reporting earnings next week, but what I'm kind of interested in here, is there a really big short interest? Yeah, so 17% of the float is short. That could account in part for what we are seeing today. Okay, moving on. Next name after Wolfspeed. Okay, so here we've got a little MicroStrategy. Anybody who reads the Options Edge, which is the website, most of those articles are written by my good friend, colleague, Professor Mark Guthner from Rutgers, former colleague. This is probably not a big surprise. You know, we saw, actually, rather than this, I'm just going to pull up Bitcoin because MicroStrategy is basically a Bitcoin story, and we can see that basically has regained a little bit of mojo after getting punched in the face. So since Friday, which is when it hit its lows, we're up, yeah, Bitcoin's up 20% almost. I mean, what was that low? Did we actually, it is up 20% off those lows. 49.2 got to on Friday. Yeah, so that's 20%. Still a long way off from 70,000, which it breached, but that story. Also, you know what, this is not exactly the same thing, but you know, I kind of liked both Bitcoin and gold going into the beginning of the year. And so this is, we're just going to take a quick peek here at GLD. No problem if you happen to like looking at gold futures instead. I rather, you know, prefer looking at futures sometimes myself. But the reason I'm pulling up GLD, the ETF, is because when it comes to trying to observe the options flow, first of all, I think there's as much or more options flow in some of the big ETFs as there are in the futures contracts. But it's just easier to distill where the flow is in terms of the term structure. And the reason for that is the options contracts, oftentimes I'm only looking at them on a buy future basis. So I'm looking at the next month, the next future, the next one, the next one, the next one. So piecing together where the flow is in terms of from one expiration to another on these tools at least is sometimes easier to see on the ETFs because it basically just consolidates it all like a stock. And gold as a commodity will tend to trade more like a stock because the only real thing you don't have short-term supply demand and balance dynamics typically with the metals, well, precious metals, the way that you can with other things. So for example, natural gas, obviously you can get a really long or short-term sort of supply demand or basis issues, not true here. So the most active contracts for GLD are all relatively short-dated call contracts. So we're looking out to a week from Friday, the 225 calls, October 235s, SEP 235s, SEP 230s, and 231s. And calls are obviously significantly outpacing puts, as we can see here. Okay, so just wanted to punch through that. You know, we're in the middle of the trading day, so I wanted to make sure we could touch on some of these things. Oh, I figured we would just take a quick thing here. Okay, so on Monday, AMQB, how are you positioning given the current uncertainty? I don't know if you've been watching these live streams since I started doing them. I've kind of talked about this a little bit. In early July, I was just an outright put buyer. So 30 delta out about 45 to 60 days. It was 60 days actually at the time, to be more specific. It was July 1st. I was looking out to month ending August. 5350 SPX puts and 535 puts in the SPY. I have amended that since then and suggested deploying, so rolling the 5350s down to the 5,000, 4,500s, taking that excess premium off the table. Yesterday on the live stream, I talked about the fact that that premium was about 63 basis points of the net decline, even despite the fact that about 5 weeks had passed, which is really a remarkable hedge, I have to say, because the market was only down about 2.7% or so from July 1st. Deploying some of the excess capital from the hedge to get a little bit longer the S&P, and then upsizing the put spread. So deploying a more measured hedge down another 10%. Why? Well, I kind of talked about that right at the beginning. Getting into these higher periods of volatility without seeing, at the very least, a formal correction, and I'm looking at the S for this because we got one in the NASDAQ, but without seeing a formal correction, meaning a pullback from the prior high of 10% or more, is pretty unusual. And while we are looking pretty good today, I still feel like we could see formal correction territory before the end of the year. And, you know, this is, look, I don't have a crystal ball any more than anybody else does. You know, I will allow technicians and chartists to make their formal predictions about which way the market's going. I'm just telling you what my instincts are telling me, and I'm just saying that statistically, it is not common over the last 35 years to have volatility tick up the way it did at the end of last week and the beginning of this one and not get at least into that formal correction territory. Wait, you know what? I think, do I have it? Aha! Oh yeah, let's share my screen then. So what are we looking at here? So this is, okay, really quickly. So what are we looking at here? This is pull down. This is market drawdowns when the VIX breached 30. Historically, 340-ish days. Is that what we got? Sorry, it's hard to read. So don't worry about the numbers on the index. Let's count of the number of instances where we have seen this over the last 35 years. These are the pullbacks we've seen that correspond to increases in vol. Usually the increases in vol are a result of the pullback. But what I'm saying is where we are right now, which is all the way on the right-hand side of this chart, is unusual. It's really uncommon to get this kind of uptick in volatility, which is, you know, potentially liquidity issues, and not get something more either the month prior or the month following. Okay? I'm not saying it can't happen. It happened in October, November 2020, another presidential election year. Could be the same thing. I don't know. I'm just saying it's not common. So to me, I still think it makes sense to be hedged, but because we have this increase in premium, and I don't mind deploying more capital to the S&P when we get these upticks in implied volatility. You should do that. That's just what the data shows. Chances are the market's going to be higher, and that chance is better when markets are higher. But I'm just saying that the circumstance we're finding ourselves in right now, big increases in volatility, lots of uncertainty, but the market is still, you know, within 6% of its all-time highs. That doesn't happen too often, and I am not convinced that that's how this one's going to play out all the way to the end. Hope that helps. With NVIDIA moving up around 5%, is it wise to be bullish, I'm assuming, or bearish? Look, 5% for NVIDIA, valuation-wise, who cares? Really, it doesn't make that much of a difference. If you're long-term bullish NVIDIA, you're long-term bullish NVIDIA. And so far, nobody else has really, no one has really come up with a viable competitor to their offering. I'm expecting that that probably will happen. Look, every material position of technological superiority where you had just one standout player, you know, ultimately they ended up seeing technological migrations, or they saw competition, or some form of both. I think that probably happens here. But you know, NVIDIA is going to be the best of breed, which is going to lead me to the next question or comment, which is coming also from Monday AMQB, which is how to hedge a large NVIDIA position given earnings later in August. And the answer to you is going to be put spreads. It's just too expensive. Can't really do it any other way. Let me come up with an example. So we will just pull up NVIDIA real. Actually, let's see. See how big the implied move is. So the implied move for NVIDIA right now is 10%, which seems reasonable. I mean, over the last 8 quarters, we can see right here, it was up almost 10% the prior quarter. It was up over 16% the one before that. 2 relatively quiet quarters prior to that, but then we had an up 24 and up 14. So, yeah, that's going to make the options premiums pretty expensive. And we are going to be getting that at the end of the month. So what you would be doing is trading a put spread against your long there. And if you wanted, you could try to do a zero cost put spread collar. I don't think I've ever mentioned one of these. So you know what? Let's take a look at that right here and now. Obviously, it has to go at least to the end of the month, but for simplicity, I'm just going to use September regular way options. So, you know, you're hedging, generally speaking, not for these 5% moves. As I just mentioned, who cares? You know, 5% move this way or that, that's what the stock's actually doing. So let's see what kind of a collar we can get on. So if you buy a 190 put spread, which is going to give you, give or take 10% protection there. Let's see what we got. Let's just make sure I put this in correctly. Yeah. Alrighty then. Let's go like this. And we'll take this up. All right, so how about something like this? This is about even money. It's actually a small credit. So you can buy the 185 September put spread and sell the 115 calls against that for a slight credit. So that gives you 12-ish bucks worth of upside between, you know, now and less than 45 days away. So we're talking about 6 weeks. So 6 weeks to go. Captures earnings, gives you 15-ish% protection against your current long position, and still gives you another 12-ish% to the upside. That would be a decent way to think about hedging. And by the way, you know, look at the chart and think about what I was just saying. I mean, look, everybody's mileage may vary. You may or may not agree that I don't necessarily think that this volatility is over necessarily, but that's just where my head is at. And I'm just going to take a look at the 150 here. I think we're getting very close to it, right? So there we are. We touched it here. So the real question you want to ask yourself is, okay, we've got earnings coming out. Is this thing going to fall below the 150, or is it going to bounce off of it? And, you know, I think it's fine to stay long, like I said, in terms of, you know, they're in the dominant position. But, you know, maybe something like a zero cost put spread collar. So if you're going to do that today, we just saw the prices that work. If you're going to do it tomorrow or Monday, now you know how to manipulate it. Just think about how far out you want to go. Obviously, you want to capture the event, right? So that's doesn't do much good if it expires before then. So you just manipulate the strikes till you get effectively, think about the difference between the current stock price and the strike of the put that you buy as the deductible that you're willing to accept. And then you just basically try to get the net premium close to zero. That's a zero cost put spread collar. So that's what I would suggest for you there. And NVIDIA options are massively liquid, so you're not going to have, even if it's a big position, you're not, well, how big a position? I mean, if you have $1 billion worth of stock, that might be tricky. But if it's something significantly smaller than that, then is it good to capture earnings since vol may spike? Is it good to capture earnings? I'm not 100% sure what you mean by that. Are you asking me, if you own the stock, should you try to trade it through earnings and hold it? Well, at least historically, the answer to that question has been yes. So the stock's been, you know, the company has been blowing away their numbers every single time. And if you had decided not to hold the stock when they announced, you've missed out pretty significantly on some upside. And that also makes sense, right? So maybe 40%, and in a stock like this, perhaps 40% of the returns that you experience over the course of the year could be coming from events like earnings. So you kind of need to own it. But if you are reluctant, and I can understand why. I mean, we obviously have seen that the market is a little bit on eggshells here. That's why you would hedge. Okay, so these are intended to be much shorter than the post-close open mics where I'm taking more questions. Just want to make sure that I'm talking about some of the volume that's hitting today, things to think about in the today, the next day. I think we've done that. I've chewed up 30 minutes of your time, more than 30 minutes of your time. For those of you who tuned in for open markets, which is what we're going to call this. When we do a live stream and the market's open, open markets. It's the Open Interest YouTube channel. Everything's going to play on the word open. And I'm glad that you guys were open to tuning in for this one. Appreciate your participation in all of this and really appreciate the comments and questions. And we're going to try to do more of these, and I hope you will tune in for those as well. And you will know when they are coming because these are a little bit more irregular. If you like, subscribe, and hit the notification bell, you'll get that notification and you're going to know that we're going to fire one of these things up. Sometimes it could be last minute. Thanks for watching.